Hello. The next panel we have coming up is governance within global markets. In terms of environmental, societal, and governance factors that fall within the ESG framework, governance is often the most overlooked. This panel is focused on addressing this disparity in hopes to illuminate governance factors such as policymaking, responsibilities of stakeholders, and how risks are managed. And now I'll turn it over to Dan Keeler, editor for Frontier Markets for the Wall Street Journal, as soon as we have that.
He's there.
Yeah, he's there actually.
Oh, perfect.
Am I here?
Yeah.
I believe I'm here.
Awesome.
Good afternoon, and thank you very much for having me as the moderator of this panel. So today we're going to be talking about governance, the G part of ESG, which commonly doesn't get as much attention as the social aspects of ESG or the environmental aspects, perhaps because it's less visible. My aim today is that we will restore that balance somewhat and explore the importance of governance in emerging markets. I'm joined by a star-studded panel of experts and practitioners in the field. I don't see anyone on the stage yet, but I'm hoping the panel will be here. Joyce Chang, who's Managing Director and Chair of Global Research at JP Morgan. Thank you for joining us, Joyce. We also have Frank Brown, who is Managing Director and Operating Officer of General Atlantic. We have Claude, unfortunately, I don't quite know the pronunciation of your surname, actually, Echahamian? Echahamian? Full disclosure. And we also have joining us virtually, I believe, Paula Kovarsky, who is the head of the US office and investor relations at COSAN Brazil. Sorry, I should have mentioned that Claude is the president and general manager of Corning Corporation. So welcome to our panelists. I'm very much looking forward to discussing this topic with you. Let's jump right in. So I'm going to start with Joyce. Joyce, I understand you have some slides to help set the scene for this conversation. But before we get into those, could you just tell us a bit about yourself and your role at JP Morgan?
Well, thank you so much, Dan, and just such a pleasure to be here in person with all of you students. And I know it's been a long journey for you during this pandemic, but just thrilled to see you all in person. And thrilled to see people I have worked with at JP Morgan here who are so interested in the school and in this program. I'm Joyce Chang. I'm chair of global research at JP Morgan in Midtown Manhattan. I started my career in research 32 years ago in emerging markets. And all of that experience in looking at crises, I eventually, at every crisis, took on more of research, global financial crisis, Eurozone crisis, and now I chair the global research department. We have a whole dedicated effort to ESG, including an index group, a way that we score stocks, and the way in which we work with multinational companies and portfolio managers on their ESG strategies. So I am just really delighted to be here and to be with this wonderful panel.
Well, thank you for joining us. It's a real pleasure to have you with us. So I mentioned that we're going to be setting the scene to an extent. So we have the slide right now, which is building the future on ESG excellence. Do you want to give us a quick run through on what that actually means? I'm sure lots of people in the audience are curious about ESG and perhaps have heard the three letters a lot, but perhaps would like to learn just a little more. So can you just talk us through what building the future on ESG excellence really means?
Well, ESG has moved into a must-have, not a nice-to-have. And the pandemic has really accelerated this transition. Before, most of the focus was on the E, but the S and the G really did rise in the pandemic period, with much more focus on governance, race, equity issues, and also a real focus on what we can do on standardization and how we can put in rules of the world and governance into place. So I think that we are now seeing that portfolio managers, corporations are coming out with ESG policies even before the government. JP Morgan has announced its own targets to go to zero emissions. And we are seeing that it's being mandated by the shareholders to really show what we are doing on the ESG front, a much closer look at what the investments are, and a real dilemma right now. And that's what I'm going to really talk about a bit in the slides, is that we are facing actually the first energy crisis in the decarbonization era. And that is really prompting a debate about what do we do, because the transition to clean energy is decades away, but we will still need fossil fuel for much longer. So I don't know, Dan, if you want me to turn just quickly to the slides.
Yeah.
So
Yeah.
I call this really, the good, the bad, and the uncertain. So let's just pull up the first slide. So the good is that we're synchronized. The Trump era is over. We rejoined the Paris Agreement, and you can see emerging markets have also laid out their goals to go to clean energy. Now, their longer term goals, India's goal is 2070, and the 2060 goal for China, they have not even hit peak use of fossil fuel yet. So these are longer term goals. But what you do have is finally we have a synchronized global picture. That's the good. Now, the more uncertain, if we go to the next slide, is this is a very long, hard road. And you can actually see that the top 10 emitters in the world, many of them are emerging markets countries. You can see China right up there. You can see India, Russia. But you look at this list of the top 15, the top 10 emitters, you account for 74% of carbon emissions. And very few countries have concrete plans where they can meet these Paris Agreement objectives. Emerging markets economies are the most vulnerable. And where we see the biggest shift that needs to occur is actually in power generation. The share of renewables there actually needs to double to 50% by 2030 before the end of this decade. But
sorry, when you said the most vulnerable, you mean the most vulnerable to the impact of climate change?
Most vulnerable to the impact of climate change.
Yeah.
And I will really show that on the next slide. So if we turn to the next slide, the adverse consequences of climate change are disproportionate to emerging markets. And this is on the environment, but this is also true for social and governance. All of the work we've done looking at the pandemic, how it's disproportionately impacted women, how it's disproportionately impacted the lower income countries. But sticking specifically with climate change, you can see that they are the most vulnerable because they are the most dependent on agriculture. It is sub-Saharan Africa, Southeast Asia that have the largest vulnerabilities, and then the more developed emerging markets countries in Central and Eastern Europe, are least vulnerable. East Asia, as you go to the more advanced emerging markets economies. But we've seen this not just on the energy side. I mean, if you take a look at the statistics, and even taking a look at the United States, I mean, we are looking at a female labor force participation rate, which is at a 33-year low. And that we have seen low income groups much more disproportionately impacted. So that is the good is the goals, the bad are the challenges, but the other bad, which is the current situation that we're sitting in on the next slide, is the greenflation. So, we're now talking about whether oil prices could go to $100 per barrel. We have them at $85 for this year, but with upside risk. And if you look at just the impact that's having on inflation, which is what all of the macro investors are worried about right now, the 12% move that we've seen in oil prices just quarter on quarter is about a 2 percentage point feed through to inflation. And if you go to $100, it's 4%. So this is the problem and the dilemma. And you see the naysayers really blaming the clean energy movement for this energy crisis. But this energy crisis has deep underpinnings, which I will explain on the next page. And this explains the dilemma for all of us who look at this from a business perspective. So you've had chronic underinvestment by large oil companies in critical infrastructure. So we estimate that there's about a $600 billion CapEx shortfall by large oil companies as they've faced these pressures. So one thing we've tried to come up with is an energy transition scorecard that really scores how companies are doing, sort of realizing the reality is that you're still going to need fossil fuel, but that we need to score and rate these companies. But you are now seeing that, particularly as we talk about a cold winter, geopolitical risks, because Russia has been diverting more oil away from Europe into China and Turkey, we're seeing all of these pressures come to a head. So these are some of the challenges, but what does the investment environment look like? If you take a look at the next slide, 2020 was a watershed year for ESG investing because of the pandemic. And there was a real debate over this. Everybody wondered whether this would take resources away from ESG. It actually accelerated it because it put much more focus on the social and the governance issues, not just the environmental issues. But we saw an increase in ESG flows that was more than 100%, reaching $7.2 trillion in dedicated ESG assets. That doubled in more than 1 year. We saw the same thing in our indexes. And we've also seen a growth in investment in innovation. For climate tech investment went to about 60 billion this year from 36 billion last year. And we've seen, if you look at the green bond issuance, last year there was about 300 billion of issuance. We're at 360 billion year to date. So the innovation is occurring, but this still is, we're talking about goals that are decades away. We still have this crisis period. And if you look, one question I get is, how does ESG perform in the marketplace compared to more conventional assets? So if you take a look at the next slide, what we've actually seen, Europe is ahead of the US on this, but what we've seen in looking at the European issuers, they do have tighter spreads than conventional, traditional corporates that issue for the green. So there's a greenium. There's a greenium that does tend to fade after about 2 months. So quite honestly, when we look at this, but right now you're not losing money for investing in ESG, and we have seen more demand than supply. But turning specifically to emerging markets, I talked about Europe. What we can see is just this chart, and you can see the upward momentum is just the growth in emerging markets bonds in Latin America. The fastest growth has been in Asia for ESG issuance. So you have the good, the synchronization of goals, the innovation that's occurring. You have the bad, which is the greenflation and the energy crisis itself. And then you have the uncertain, which is really the greenwashing. And this is a perfect time to really turn to the governance issues for the other panelists to discuss how they are looking at it from their corporate perspective.
I think you just did my segue for me. Thank you very much for that. That was a great introduction, and actually helpful for me too. Sorry. Yeah, so as I was saying, that was actually that was fascinating to hear what you were saying about the real impact of climate change that's actually happening right now. I mean, I cover frontier markets at the Wall Street Journal, and I've had stories. Even I think over a year ago, we had a story about how shrimp farmers in Vietnam have had to change, or sorry, rice farmers in Vietnam have had to change what they're harvesting because of rising sea levels. There's an ingress of salt water into the areas where they were farming, so they're actually switching over to shrimp farming as an alternative to farming rice. And East Africa, we've seen crop failures as a result of droughts. The impact of climate change is very, very real and very worrying. Also interesting, I thought that we're seeing the fastest pickup in green bond issuance in Asia. That I think is a crucial parallel that we should kind of keep track of. But you did thankfully help me with my campaign to get governance to the front of this, because you talked about environment, you talked about the social impact of that. Now we can talk about how governance in emerging markets can really start to hopefully make a difference. Claude, I wonder if you could join us next and perhaps give us a quick intro into what you do and how you do it, and then we can dig into the governance aspect of ESG.
Yeah, thank you, Dan. So I'm Claude Echahamian. I'm responsible for what we call Corning International. Basically, in a large corporation like ours, it's everything outside of North America, almost. That's what I would call the international. Well, a bit of Europe is out of it, but anyway. And so emerging markets might represent 30% of my sort of financial outcome, but I would tell you 70% of my personal and then team activity. You need to know that, right? Because there's a lot of efforts for a corporation that is located here in the US if you want to adjust to these markets. The thing I wanted to tell you related to the governance is that if you listen this morning about the 42 countries that Anne mentioned, I would tell you that we make deliberate decisions not to invest in all of them because of the G part of the ESG, right? We got decision analysis metrics. We are an industry and we invest for decades. We want to put manufacturing assets. We want to bring our IP in a country. And so we're very careful before making a decision investing in a country that all these criteria fit into what we want to do for the long run. That's not a short-term decision. So when you do that, you sort of exclude yourself from some of the places, but because the governance become important, you want to bring with you your auditors, you want to bring with you your shareholders, you want to bring with you your brand equity, and you want to do that in a place where you think they're going to be protected, right? So that aspect is very important. I want to be very clear. Then the other experience I could share with you as a large industry is that when we decide to invest into a certain place, so the E and S is like a no-brainer because we as Corning, I mean, we do that since many years, and so we're not going to downgrade what we do here in the US and do anything different elsewhere. That would be foolish. Then the G part is where we bring our processes and we try to adapt and adjust also to the local context. And so sometimes even our partners, when we work with partners in countries, they don't understand why we're so picky about all this and do we really need to do this? Do we really need to do that? Yes, we do. And to a certain extent, sometimes there might also be frustration because you lose business or you turn down business. And I'm used to telling to my folks, not all business is good business. On the short term, it could be, but not for us. We've been in business for 170 years, and we want to still remain for long. So not all business is good business.
I just have a question about that, actually. When you're dealing with people who don't really understand the importance of ESG, and they're just saying, why do we have to do these things? Why do we have to jump through these hoops? How do you actually persuade them? Do you have kind of a one sort of killer argument that you can present?
Yeah, that's a good question, Dan. I try to relate to the personal experience, the life. We all have values, right? We want to transmit to our kids. There are things that we don't want to do, even though it might be like on a short term that could be beneficial to us, right? So the thing is, like, as soon as you start putting your values, your expertise, and the way you want to carry on your business in a certain place, it takes a lot of resilience to explain why we're doing that. Health and safety procedure in the plant. There's a lot of places where people say, do we really need to do that? Yeah. Why do we need to bring expensive auditors? Why? Because we need to report our numbers properly and so on. So you're right. There's sort of education, Dan, that you need to spend a lot of time to do. And it takes time, but the explanation is about the resilience, the fact that you're not there for a short run. You're here to invest in the country for the long run.
Once you've established that, you've kind of got the point across and they understand it. Do you find that that people in those markets will actually be taking the initiative then and sort of grasping this and saying, you know what, yep, I get it. And we're going to really push to kind of improve our ESG and maybe to get ahead of the curve?
I think the employees get it really quickly because of the S part of ESG. They understand your culture, they understand what you're trying to do, they understand that the environment, you're trying to do the right things for their country as well. They live in this country. So that helps a lot for them to understand the governance becomes important. Now, when you start losing tenders or opportunities, there's always the donkey bonus. I'm sorry to say so, but there are companies that don't respect anything. They're very cheap and win the business. On the short term, they do. But when your strategy is long term, you will win it back again, one day or the other. You will win it back. If you do the right things, you win it back. So it's difficult then because your vision is long-term and people act on today's reality, right? But you need to convince the people that this is what we're doing is for tomorrow. We're building a foundation that needs to remain in that emerging country after we disappear for our kids or for their kids. That's what
I think
it takes.
It's interesting to sort of tie this back to what Joyce was saying about the growth in green bonds, because I think that's one of the key things that green bonds can do is to provide finance for projects that are environmentally friendly, to be able to keep companies like yours that are companies that are keeping a focus on ESG who might be perhaps a little bit more expensive than those that don't. Green finance, I think, can help to build that business and to therefore support the kind of move towards more responsible governance. Is that something that you see as a prospect too?
Yeah, absolutely. I mean, it will take time, but there's a push-pull situation where the investors community is going to push for green bonds, for more social responsibility from the top. As Hélène alluded to this morning, the consumer are also going to push for that. So the industries in between, like ours, and the context, will also have to evolve because of this push and pull. So the more the investors community will do on that, the more the consumer will do on that, the more the industries and the producer will have to adapt and adjust. And this is where we win on the long run.
Right. I'm seeing, I can actually read on the screen there that we've got a couple of audience questions in that are very pertinent to this particular point in the discussion. So I'm very interested in your thoughts on whether companies and governments tend to go by one or two components of ESG, whether they sort of mix and match or pick and mix. Some do the E, some do the S, some do the G. What, in your experience, are you seeing that where it's very selective, or that is everyone kind of doing all three?
Sorry, are you referring to the first question here?
I am referring, yes, the question that's just leapt to the top of the screen. Yeah. The top of the screen as I see it. I'm not sure if that's actually the top of the screen.
Yeah. Yeah. You want to pick it up? No. Okay. I think it's different fold. As I said before, the E and S is pretty much our decision, right? The way we treat our employees, the way we deal with environment, and we recycle and we care about the energy and so on, it's kind of our decision. Even though there are some regulations, there's labor law, of course, but they are not as restrictive, as we are, or as demanding as we are. The G is a different animal, which really is kind of dependent on the context where you operate. You're trying to bring your own vision, thanks to your shareholders and your investors as well. But the context is kind of difficult. So I think the panel here is about the G, and I think it's important because it's not the simplest one to talk about. I think we're going to allude to that.
Yeah. Maybe I can just add a few comments on the G as well. If you take a look at the way that indexes are constructed, the G is the hardest element to actually measure. So a lot of people have asked me, ESG, why is it so focused on climate? Why not the S and the G? So let me just give you some examples. So let's just say I want to put gender in an index. So there's 96 indicators in an index. And people say, why are there only 2 about gender inequity? And that's because the only good data you can get that's standardized, that you can get with regular frequency, is women on boards and women in the C-suite. So there might be a very good human development index that has come out, but if it only comes out with a data point every year or every 18 months, it can't go into an index for an investor. And you see a lot of these same issues that will come up on governance, is that people will talk about it, but then when you say, how do I measure it from an investor's point of view and get data that I can actually rebalance an index with once a month, you will find that there's actually fewer indicators. So it's very focused on the E because you can measure pollution. You can do the negative screening. And so what you see is a whole framework that is now changing in the industry, where we don't want to do just negative screening. We want to do intentional behavior. We want to do double materiality, where we look at the financial impact and also the environmental and the ESG impact. We want to see if we can come up with other metrics to put in. But you can see some of the problems that you come up with in trying to construct investment vehicles, because they have to be ones that are replicable and liquid and measurable. So this is one reason why when people ask, why is there such a skew on the E, when we talk about it, it's partly because tracking it is quite difficult.
Yeah.
If I may, I'd also add that on the governance aspect, you also, particularly in emerging markets, you need to look both micro company level and macro country level. So micro, what's the structure of the board and all the various things that Joyce was talking about? How relevant is the board to management and what's the relationship, et cetera? And you have to think about public versus private companies as well. But the macro is crucial. What is the rule of law? How present is it? How respected is it? What's your opportunity to take advantage of that? Is there a stroke of the pen risk? I won't mention names, but there's a big country out there where there's a huge stroke of the pen risk. So you have to think about those things as well from a governance standpoint.
Yeah, actually, let's stay with you for a minute, Frank. I know you must have been champing at the bit as we were talking about all these different aspects to kind of put across the investor's perspective. So much of this has an impact on investors, but I'd love to turn it around and look at the impact that investors can have on how companies and countries behave. How can you get more influence over governance? And yeah, I'll let you run away with that one. Looks like you're ready to go.
So just a few words in case. General Atlantic is a global growth equity firm. We have about $85 billion under management. We have about 200 investments in our portfolio. The largest of which is a little company called ByteDance in China. You may have heard of it. It has TikTok. Another huge piece of our portfolio.
This isn't the stroke of the pen risk you were thinking about, was it?
Actually, ByteDance is pretty safe from that stroke of the pen risk because it's a consumer business. But the other one that's interesting from an emerging markets perspective is a little company out of Uruguay, which was just mentioned in the video, called dLocal. And a huge trend is providing banking services and access to financial services for the underserved and underbanked around the world. So that's a big LATAM business. Now, in terms of what do we do as investors to help this issue, which I think is the gist of Dan's question, which is a very good one. We have a very tight screen across all levels of ESG for every investment we look at. I'm responsible for signing NDAs, 2,000 a year, running down to you do about 50 investments a year. And ESG is a big part of all those things. Now, we don't get too involved in environmental because we're a very low asset light investor. So we don't do any industrial. So that takes a big piece away to it. But the societal and the governance aspects are huge. And they're prevalent in every decision we make. And then when we do make investments, particularly in private companies that are underdeveloped, before we sign on the dotted line, we have an agreement with them about how we're going to operate and how we're going to govern the company, how we're going to grow the company responsibly, and how we're going to build it. And if you don't have a meeting of the minds with that founder where you can, look them in the eye and say, here's what we're going to do going forward, and we all agree, and then we go off and do it, then you don't do the deal. So I don't know if that answers.
Can you give us a specific? Yeah, no, it does definitely. Can you give us a specific example of a conversation that you've had along those lines that has maybe had an impact on how that company behaved?
So we're in the middle of one right now, so I can't name any names.
Okay.
But it literally is a situation where a founder who has control has some elements of their past that are, shall we say, less than desirable in terms of how we want to partner and how we want our reputation. So the conversation is very simple. Sell down your stake, take a much less active involvement in the company, let the professional CEO run it, and we have a written agreement with the CEO and the board in terms of the way forward. I don't know that we're going to do the deal, but that's a conversation we've had in the last few days.
Great. Yeah, that's really interesting. What about in the past? Are there any deals that have been done that have succeeded where you can kind of point to your involvement as having changed the trajectory of the company's behavior?
Yeah, there are a whole bunch in terms of behavior, and I think probably the most important one I would point to, and again I can't really name specific names, but I can name regions and types of businesses. But again, it has to do with payments business and access to electronic payment mechanisms, and what geographies are we going to serve, and how are we going to enter markets and create an environment where it's easier for people that are lower down on the socioeconomic scale to access the services they need. So it's very much an agreement in terms of, and it was in the Middle East, and it was very much an agreement to enter certain markets with that in mind, and it turned out to be a huge home run. And is now a public company and performing extremely well.
So this is an example of doing well by doing good. Is that fair to say?
Yeah, and I think, Dan, investing has to be a win-win. But you always have the decision to make as to whether you go forward or not, and where you decide to go forward, you support it every step of the way.
Yeah. I think all too often in the past, the winner has definitely not been the environment or the society, the people. And hopefully that's changing with this focus on ESG. I'd love to bring Paula into the conversation now. Paula is the head of the US Office and Investor Relations at COSAN Brazil. You're obviously going to have a unique perspective on ESG. I'd love to hear, firstly, a little bit about you and your role, and then perhaps we can talk about the how ESG might differ in certain regions or markets and how that affects how companies have to act.
Yeah, hi.
So Paula,
hi, everyone. Thanks once again for the invitation to join Cornell's panels. I have over 20 years experience in the industry. I worked for Shell. I've been head of research for Itaú BBA, which is one of the largest Brazilian banks. And then I joined COSAN, which is one of the largest conglomerates in Brazil in energy and logistics. We have roughly almost $30 billion worth of revenues under management these days. So COSAN is essentially a big holding, or a big portfolio manager, or a big capital allocator, right? In all those businesses and growing. And I joined the company essentially to reassess the way market perceived that company, which is a very particular one. This is a family-owned company that started off as pure sugar and ethanol back in the 30s, right? To become a widely diversified conglomerate that still has a controller, and a very active one, but managed very successfully, I would say, to professionalize management and to professionalize, the boards and the governance structure and so on and so forth. And so we decided in 2017 to open this branch office in the US. And the very reason was, let's try and find the type of shareholder that shares with us at the holding level the long-term and sustainable perspective, right? So we started to look at ESG and the ESG framework as a way for us, again, a holding company in energy and logistics, in businesses in Brazil that are, we're essentially into renewables, we're essentially into infrastructure for agribusiness. So we are essentially into sustainable businesses in Brazil, right? And so we wanted to find the shareholders that would share that view with us, because beforehand, the sentiment was from some of those other shareholders that there was a disconnect, or there was a misalignment between the controlling shareholder and the minority shareholders. And to be honest, in my particular view, the only disconnect was about the duration of the investment, right? So we were essentially thinking long-term, and some, or the vast majority of our investors were more focused short-term. And I think this is an issue in particular in Latin America and in Brazil, right? Which is a younger capital market where eventually you see, more people focused in, next quarter results and stuff like that. So we decided to take ESG, or let me put it that way, I sold the whole ESG concept internally, right, as an amazing opportunity for us to talk about everything that we were doing already, right, in a format and in a way that investors would understand. And then we decided to add another E to the ESG, which is the E of economic, because we very much think that to be sustainable long term, it needs to make financial sense. It needs to make business sense. And then back to the beginning of the conversation on governance, right? For us at the holding level, governance is probably the most important tool for us as a holding to enforce those policies and those ideas and those guidelines and the strategy, right? So we worked very hard in making sure the governance, the holding company had a very clear statement to all of the companies that we control, right? They had a very clear statement about what exactly the values were and what exactly the management tools were, right? And at the holding level, we need to kind of exercise this through the boards and through, the shareholders meetings and so on and so forth. And it has been working pretty well. And again, back to the second E, right? I think investors have a tremendously important role in this whole process of making ESG a real criteria of investment, right? And it kind of goes along with the view that not necessarily you have to, governments will solve all the problems. And we mentioned that in the beginning. You have, the industry and the private investors also have their role in helping improve the E and the S, right? So I think the beauty of the story of having capital markets, of having $7.2 trillion of money dedicated to ESG, as Joyce pointed, and the whole green bonds industry and so on, is that investors are always more focused in making sure that promises are fulfilled, that you say something because if you go out and say, my guidance is $1 billion EBITDA, and next year I do 900, where share prices will go, right? And so I think there's a very interesting virtuous cycle to be built between companies and investors, in the way that companies make their promises, companies make their commitments, investors buy the shares, right? And then they are at the end of the day responsible for the checks and balances. And to me, that's it all has to do with governance. Governance at the end of the day should be the tool through which you make sure your E&S commitments are, enforced and are clear and are, checked every year, and that people get, remunerated appropriately for the things that they do. And at the end of the day, again, back to the E, sorry, the very reason why sustainability moved from, like to say, from the kitchen to the living room, right, is because everyone understood that there's a lot of money on the table, because the successful companies will be the companies thinking about the businesses that are sustainable. They are the companies that will be able to attract talent. They are the companies that will be able to retain talent, and so on and so forth. So this has been a very, very interesting experience for us at COSAN.
Yeah, I bet. So it's interesting. I was talking to the chief sustainability officer at a major multinational recently, and she was saying that she views the ESG report, their sustainability report, as generating alpha. This is where you can actually build your investment returns for investors and for the company itself. And it's symptomatic of just how deep the concept of ESG is kind of embedding itself in corporate mindsets. But you talked about a number of different things there, and I was sort of left with a slight kind of ambiguity, in a sense, that is a sort of closely held private company or closely held private-ish company more likely to be able to push forward really kind of forward-thinking ESG practices, or is a company that is beholden to the whims of the investor community more likely to do that because of the power that they might wield?
I really, really, really struggle with that thing, because I don't think being a known company or a full corporation means you're going to do better or worse in terms of ESG. You know, I mean, working for a company that is listed but is controlled, right? What I can say is we have the agility, we have the risk taking, we have the guts sometimes to do things and to make sure we enforce and implement things sometimes faster than, or we are able to take decisions faster than the large true corporations, and we make things happen. But that doesn't mean that a true corporation, you know, cannot, you know, reach the consensus and move forward with decisions. So at the end of the day, I think it's more about the commitment, the purpose, and being true to your aspirations and making them happen than a debate on whether, you know, it's a known company or a corporation. That's my view on that.
I think one of the key things and a theme that's emerged in everybody's comments so far is the long term, you know, being able to think long term, being able to commit to long term performance. And obviously that, you know, is somewhat easier in a privately held company where you're not producing quarterly reports and being you know, brutalized by the stock exchange or by the investors. But so I'd love to pick up on that with Claude, actually. You seem to have a sort of long-term perspective. Do you feel that long-term perspective is growing in other companies, that there is an appreciation of that, or is it, you know, are you lucky in the sense that you're able to take that perspective?
I think this is helpful when companies start to think long-term. Of course, our shareholders are looking at quarterly report. We get that. I mean, everybody's going to look at us. There's going to be ups and downs. We're very conscious about that. But what is more important, particularly when you make large investment, assets investment, IP, R&D, is to have this longer trend. And this is where we've seen with Corning that it always pays off. When you start looking long-term, it pays off. Of course, you need to also deliver the growth. You need to respect the financial KPI, unless your investors are going to beat you up, no doubt. But if you respect that and you keep your long-term vision, it works. Now, related to the governance and the long-term, Dan, there's something which I'm worried about and I want to share with you, because a lot of you are part of the financial community or will be in the financial community, is that the digital economy has made a lot of the companies outsourcing a big chunk of a value chain. To a certain extent, in the production of a service right now, some companies only control 10% of value chain. This 10% could be 50% of a profit, by the way. But so this 10%, the company that controls the 10% might be totally nice on ESG, but how about the 90%? So when you're going to invest in that company, how can you make sure that the 90% of a delivery of a value chain is going to be okay to your standards? And we see that more and more, the delivery of services or products, it's a challenge to understand exactly who's been part of it. Sometimes the company don't want to disclose that too much as well. So the long term is also making sure you have a vision for what you want to do and what you want to be on the long run. What is your skill? What is your expertise? Where do you put your R&D money on the long run that it's going to pay off as well? So just, Dan, it's a little bit of digression to your question, but I think this digital economy thing is kind of a challenge now.
Yeah.
Because we need your help as investors to check that.
Well, we're doing our best. So I sort of want to ask the panel as a whole this. A question's coming from the audience, which is, do you find a bigger problem in measuring governance due to the disparity between legislative progress and real implementation, weak or lax compliance? This is a question that's occurred to me and to journalists generally, is, you know, how do you measure this stuff? It is much more, it's slipperier than environmental or social performance.
Can I take the lead on that?
Totally, certainly.
Since I used to be in the business of measuring things when I was at PwC, I think that is one of the biggest issues we have right now. When you go back to the question of public versus private, because there are no metrics, there are no widely accepted metrics and no accountability for metrics, it's very murky. So I would say the public company guidance is really driven by shareholder activism. To the extent they want to push for ESG, that's what you're going to get, and that's who's holding accountable. But until the SEC or Sustainability Accounting Standards Board or somebody like that comes up with agreed upon metrics by industry, which can be audited, we're going to be in the same free-for-all we're in right now.
Yeah.
Yeah, if
Well,
I may
that's-
add to that, Dan,
Sure.
we face that challenge on a daily basis. I mean, as I said, COSAN is in different businesses, but what we essentially do logistics, we do sugar and ethanol, we do fuels distribution, we do gas distribution, and so on. And then you go to the rankings, right? And there's one particular ranking, which I'm not going to name, right? But that classifies us as refining and pipelines, which accounts for 3% of our EBITDA, right? And then they start from there and they say, so this is a high risk activity. Those are the usual issues for that kind of high risk activity. And then they measure what are the management tools that we have in place. Well, if this is not our core business, chances are that we won't have the management tools, I hope, right? And so you get bad scores. So I'm totally with you that, you know, we desperately need clear standards for metrics in different industries and also in different countries, because, you know, Brazil is different from the United States, which is different from India, and off you go. You know, we issued a green bond to our railway company, right? And when I started building the framework, the question that I was receiving from the bankers was, well, I see you're going to electrify your railroad. And I said, no, Brazil is a continental country with 60% of the matrix based on trucks, which are actually half of it is informal, right? So I'm building the infrastructure, and that's a sustainable and a green investment because I'm taking trucks out of the way. So, I mean, I think not only clear criteria, but also somehow adapted to the idiosyncrasies and the social issues of emerging markets is a must.
Yeah, well, I mean, the issues, as you just illustrated there, can be incredibly complex. That you know, again, in the markets that I cover, sub-Saharan Africa, they're talking about the energy mix, and you know, many of them have access to fossil fuel that will help them to power their economy, which will help them to develop and then to produce more clean energy in the future. But it's a complex puzzle, and you can't just say, well, we're not interested in investing because you're not putting up solar panels, you're building a coal-fired power station. It's very, very tough. But so it does raise the question about standards. I understand that there's a push to kind of create a global standard, or to at least kind of standardize the standards that cover reporting for governance, ESG, environmental and social. And that seems to make sense logically to me, because companies obviously, you know, you as a corporate officer don't want to have to be dealing with a dozen different standards to satisfy all of your different investors. But at the same time, you then potentially miss those nuances. What does the panel generally feel about this push toward a sort of global, a global bar that everybody has to get over?
You want to go?
Well, I can just share some of the analysis that we tried to do. We tried to ask the question whether democracies outperform. So what we took was the Freedom House Index, and we looked at when countries are downgraded, how does their performance actually then track from an investment point of view. And we actually saw that, you know, there's like a 5 percentage point drop in the performance. So it is also trying to figure out the data. It's very hard to get the data. So the Freedom House Index does measure, you know, the regime and rates it. So we actually did try to track that against some investment vehicles, and you know, you can actually see a clear underperformance.
You found a meaningful correlation there.
Yeah, I would just add, if I may, Dan, global standards are always easy to set, but then how you rank accordingly, it becomes more difficult depending on the company's scope, depending on the industry, et cetera. So like we see with COP26, it's probably unfair to put India and China on the same radar screen as more developed economies. So you have to set standards and then acknowledge that the measurements are going to be different from place to place and what is the reason. And I think if the standard setters and the auditors and the investment community can understand that, we will move over a long period of time to global rules and global norms. But before, there's a long, long way to go before you have that.
Yeah, yeah. So I would just say, we have about 10 minutes left. Love to hear more questions from the audience. You could put them into the Q&A in Zoom. I'm not sure if there's any other avenues that questions can get to me in my strange ethereal space, but do put questions in if you're interested in directly communicating with the panelists. Otherwise, I'm just going to monopolize it with my own questions. So one question that we did get earlier on is, what role do multinationals play in advancing the ESG agenda in countries like Brazil? I've got a feeling who might want to answer that, but Paula, let's launch into that with you.
I mean, COSAN is actually the reverse example of a multinational, right? Because we are huge in Brazil and we have smaller operations outside of the country, right? But even so, our lubricants distribution business is international. All the rest is in Brazil, right? But as I was telling in the beginning, when we decided, for example, to open an office in the US, as part of my responsibilities, I had something like raise the profile of Brazil, or talk about Brazil in a different way, or tell people that we have an amazing, for example, that we have an amazing renewables industry, and that we produce 2-3 billion liters of ethanol, and that this ethanol, this 100% ethanol fueled car actually is less pollutant than an EV if you do the complete life cycle. So let's talk about it. Let's tell the world that Brazil has lots of weird and strange political things and animals, but there's a bunch of things that I think the private companies in Brazil in general, be it multinationals or Brazilian companies, are trying to do to move that agenda forward. And there's many examples of associations and groups that are desperately trying to let the government and let the society understand how important those standards and those rules are, so that Brazil can get investments at the end of the day and can develop, right? So at least for us at COSAN, and I think this is very much a characteristic of the group, right? We take the role from a corporate standpoint and from an individual standpoint as and when we can, right? To talk about, or to make to at least to be able to show something that is a little bit different than what's in the surface, right?
Right.
While acknowledging all the issues that we have.
Yeah, definitely. Claude, what do you think? Can multinationals advance the ESG agenda? Can they play a role in advancing it beyond their own operations?
Yeah, I'll be more general, even though Brazil is part of my region, but I would say the challenge is the one that we mentioned today, is how do you measure the G part? We as corporations, we all measure by standards: revenue, EBITDA, ROIC, easy. We're measured that way. The G piece, man, oh wow, it's difficult to measure. And when something is difficult to measure, people tend to say, well, what shall we do with that, right? And so it's more related to the way your company is going to be able to evolve in these emerging countries. So you're going to be able to adjust and stay for the long run if you respect certain rules, which are going to become sort of, I don't like the word standard in that case, but ways to do business. They will become one way or the other by adoption, by not necessarily by regulation, but more by the fact that everybody pushed by you, the investors, forcing them to react. So you have to be part of it. It might not be exactly a standard. It might not be exactly something easy to measure, but that's going to be something in the air, if I may say so, that people are going to say, well, like a fashion, it's not the right word either, but that you have to sort of respect in the sense that if you want to be in that country and if you want to progress your business in that country, you'll have to do that. That's my view.
Maybe I can just add that, you know, it's really your generation that's been pushing a lot of the corporations to change. I mean, we are asked the questions when people come to interview much more by your generation than others. And, you know, JP Morgan's not an emerging markets, you know, corporate, but it operates all over the world. And we've had to change a lot of things, but I can give a couple of examples that are more US centric, but they point to the way in which companies have had to evolve. So, you know, I'm the senior sponsor for both our women's network and also our Asian employee network. And a few years ago, Jamie Dimon came out and said, like, I want you to do career development and leadership and recruiting, but also you need to increase the lending to women-owned businesses and minority-owned businesses. And he set out hard targets, $10 billion. So, you know, this year on lending to women-owned businesses during the pandemic, women have a real shortage of capital all over the world. You know, we hit $12 billion. You know, it was, you know, I worked with a charity that Girls Inc., where he said, you know, we're going to train 30,000 girls in financial literacy. You know, the Asian Employee Network, the same thing. On Stop API Hate Month, it was let's look at what we're doing with minority-owned businesses and how we can support them, you know, through our local banking, community banking. So there are ways in which companies are really evolving, you know, to also try to engage younger people in working on these initiatives so that there are volunteer opportunities. I mean, a lot of young people, when they come in, they say, you know, look, you know, the whole working 100 hours a week at JP Morgan, what is it that you're doing? And so on the financial literacy, it is all the women in their 20s who are training the Girls Inc. Girls who are in underserved communities, because they wanted to be able to do that efficiently and still, you know, have their Wall Street jobs. So I think companies are adapting because, you know, your generation is making us adapt. Yeah. And, you know, and that is happening, you know, in some countries faster than in others, but it's definitely a trend that I see in all of the operations. We have researchers in 26 different countries.
Yeah, I see that across multiple different industries and in many different countries as well. The drive, the impetus coming from the pressure from the public, whether it's through their decisions on where they're going to work, through their decisions on what they're going to buy, the consciousness, and I think the amount of information available to people on what companies are doing and how they behave is just so much, immeasurably more than it was a decade ago or more. And I think that puts companies in a position where they have to really think about this. It's an existential question. You know, are we going to satisfy the demands of a conscious public? So I do feel like that's quite a nice place to wrap up. We have slightly less than 1 minute left, I think. I just want to say for me, it's been fascinating. Really enjoyed this discussion. We could have gone on for probably a couple more hours. But thank you to the audience for the questions that you put in. And thank you so much to our panelists for your contributions and your insights. And thank you to Cornell for hosting.
Nice to meet you, Joyce. Nice to meet you, Claude.